Financial stability is vital for the proper functioning of the economy. Everyone benefits from a sound and efficient banking system. It's thus worth stopping and thinking about some of the factors which may trigger financial instability. First, let's think on the individual risks that a bank faces. To understand these risks better, let's imagine a car. Cars need fuel to run, and banks also need their own fuel, funding. For a bank to be able to grant credit, it needs funding sources consistent with its business models. When analysing the quality and availability of a bank's funding sources, among other aspects, we're looking at liquidity risk factors. To drive properly, we need to accelerate and change gear depending on the speed we're going at. Similarly, a bank's decisions, for example how much money it lends or invests, have an effect on the growth of its balance sheet and the quality of its assets. In examining how much a bank lends and the quality of its loans, we're looking at factors linked to credit risk. But just as a car needs a driver, a bank needs a management team. When we analyse a bank's management quality, what we're exploring are factors related to governance risk. To drive safely, the vehicle, its tyres, and the road should all be in good working order. Likewise, a bank's IT system and the payment systems, for example, are important elements for a bank to operate properly. Risks arising from operational aspects of the bank and from the system are part of what is known as operational risk. We all know that respecting road signs and traffic regulations helps reduce risks at the wheel. And so, in banks, prudential regulation lays down rules to help prevent banking risks and to mitigate their effects should they materialise. But our car is not alone. Let's imagine a city where we're driving among many other different vehicles. So too with banks. They operate in what is known as the banking system. It's at this level, the banking system as a whole, where the so-called systemic risks arise. Let's look at the first category, cross-sectional systemic risks. Once in motion, a vehicle's size can be a source of systemic risk. If we were in a crash with a heavy lorry, the consequences would be likely more serious than if the collision were with a passenger car. In the same way, the size of a bank may be a source of cross-sectional systemic risk for the banking system. Now let's consider the size of this car. It's small, but it interacts with many other vehicles while going about its business. In parallel, a small-sized bank may have many interconnections with other banks. These interconnections may act as a source of cross-sectional systemic risk by themselves, even though the car's or the bank's size doesn't seem that relevant. So far, we have a snapshot of the system. That is to say, we have seen the cross-sectional dimension of systemic risks. But traffic moves and progresses, forming cycles. The same thing happens in the banking system. It's precisely these changes over time that lead to the second category, cyclical systemic risks. For instance, periods of over-optimism in the system that may contribute to create excessive credit growth at the aggregate level can be a source of cyclical systemic risk. As with risks at the wheel, banking risks cannot be completely eradicated. That's why micro and macro prudential supervision tools are so important for helping prevent and mitigate these risks. As we all operate within the banking system, it's best that we're all aware of the importance of financial stability. As with driving safely, we depend not only on ourselves, but count on other drivers being careful and responsible too.